If you've ever actually run the numbers on retiring in January versus December, the difference on a single tax return can be $15,000 or more. The lifetime ripple effects, Medicare surcharges, Social Security overtaxation, Roth conversion windows that close before you can use them, can push the total past $50,000. And almost no one makes this calculation on purpose. Most people pick their retirement month the way they pick a restaurant on a Tuesday night. It feels available. It feels fine. And they only regret it later. I've watched this happen more times than I can count. Smart people, people who built real wealth over 30 years, maxed their 401k religiously, lived below their means, did everything right. They walk into retirement feeling like they've finished the race. Then their first tax return comes back. And it's not catastrophic, but it's bad. Avoidably bad. Not because of a market crash, not because of some exotic investment mistake, because they pushed the first domino over at the wrong angle. And once the first domino falls, everything else follows it in whatever direction it's already pointing. There's also something I want to get to later in this video, a rule buried in most pension documents that almost no one reads, that can permanently change your monthly pension income for the next 20 to 30 years, based on a decision you make in the last 48 hours of your working life. Stay for that one. Here's what you need to understand before anything else. The year you retire is not like any other year you've lived. It's not like the last year of your career. It's not like the first full year of retirement. It's a hybrid, a transition year. And in that transition year, multiple income sources pile on top of each other in ways that will never happen again. Your wages don't stop cleanly at midnight on some convenient date. Your retirement income starts somewhere in the middle of the calendar. Benefits kick in, benefits cut off. Penalties arrive that are calculated on income from 2 years earlier that you've already spent. And all of it lands on a single tax return. The transition year is financially unique. That is the thesis of this entire video. In the month you retire is the one variable that controls how graceful or how brutal that uniqueness becomes. I've come to think of the retirement month as the first domino in a long chain. The other dominoes, your taxes, your Medicare premium, your Social Security taxability, your Roth conversion window, they were always going to fall. That's just retirement. You can't stop them from falling. But the angle at which you push that first domino, that is entirely up to you. Push it the right way and everything lands where you planned. Push it sideways and you spend the next 2 years watching pieces fall in directions nobody warned you about. I'm going to return to this image throughout the entire video because it keeps being accurate every single time. Let me show you what I mean. There are 4 financial systems that collide in your retirement year: taxes, Medicare, Social Security, and what I'll call the conversion window, your Roth opportunity, plus your exposure to sequence of returns risk. Most people walking into retirement are vaguely aware of 1 or 2 of these systems. Almost nobody thinks about how they interact with each other. And the interaction is exactly where the real damage happens. Before I get to what I genuinely believe is the most dangerous piece of this, and I will get there, it involves a government fee that arrives 18 months after you thought the financial transition was already over. Let me start with the piece that surprises people first: the income stack. In any normal year of your working life, your tax return is simple. Wages, maybe some investment income, standard deduction, done. In any normal year of your retired life, same simplicity. Pension, Social Security, 401k withdrawal, filed. But the year you retire? You have both. You have a partial year of wages, which could be anywhere from 1 month to 11 months, depending on when you stop. You might have a year-end bonus that was already locked in before you announced anything. You might have stock awards that vest on a calendar schedule, regardless of whether you're still in the building when they do. You might have a PTO payout. And on top of all of that, depending on your timing, you might be starting your pension, taking your first Social Security check, and making an initial 401k withdrawal to cover the cash flow gap while your other income sources get organized. All of that lands in the same tax year. That is the income stack. And the income stack does one specific thing with great consistency. It pushes people into higher tax brackets than they'll be in for any other year of their retirement. Here's how bad that can get with real numbers. Imagine you earn $120,000 a year. You decide to retire in November. By November, you've already collected roughly $110,000 in wages. Your pension starts. Say it pays $20,000 annualized, so you collect 2 months of that, about $3,000 by year end. You take your first Social Security check in December, $2,000, and you pull $20,000 out of the 401k to build a cash buffer for the following year while everything settles. Add it up. $135,000 in taxable income. As a single filer in 2026, a meaningful portion of that income sits in the 22 and 24% federal brackets. Now make the exact same decisions, same pension, same Social Security, same 401k withdrawal, but retire in February instead. 6 weeks of wages, roughly $14,000. Pension for 10 months, about $16,000. Same Social Security timing, same $20,000 withdrawal. Total taxable income, somewhere around $50,000. You just dropped from the 24% bracket into the 12% bracket on a substantial portion of your income from a calendar adjustment. The first domino. That is not a rounding error. On the difference between those two income levels, $85,000 of additional taxable income created by the November retirement, the extra federal tax alone sits somewhere between $10,000 and $15,000 in that single year. Not over a lifetime, in year one. Now, here is what most people say at this point. They say, okay, but that's 1 year. I'll pay a little extra in taxes during the transition, and then it levels out. And that sounds reasonable until you understand what the income stack actually triggers downstream. Because the income stack is not a 1-year problem. It is a first domino problem. And the domino it hits next is the one that feels the most unfair when you find out about it. There's a guy I want to tell you about. I'll call him Frank. Frank spent 31 years at the same company, built a solid nest egg, worked with a financial advisor, ran the 401k numbers carefully. He retired in December of 2023. He felt prepared. The following spring, his tax return came back higher than he'd expected, but not devastating. He chalked it up to the transition year and moved on. Then, in early 2025, his Medicare bill arrived. There was a line on it he didn't recognize, a surcharge. It added nearly $200 a month to his premium. He called his insurance broker. The broker explained what had happened, and Frank had one of those moments where something that should be infuriating just becomes darkly funny. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may never show you my videos again. And stay with me here, because what I'm about to explain is exactly the kind of thing that never makes it into a retirement planning brochure. It is called IRMAA, Income-Related Monthly Adjustment Amount. That is the government's actual name for it. It is Medicare's mechanism for charging higher income retirees elevated premiums for their Part B and Part D coverage. The concept is progressive. People who earn more pay more. Fine in theory. But here's the detail that bites people. IRMAA is not based on your current income. It is based on your income from 2 years earlier. In 2025, Medicare was looking at your 2023 tax return to set your premium. If you retired in December of 2023, and your income that year was $135,000, because of the income stack, Medicare saw that number and applied the surcharge. For a single filer at that income level in 2025, the IRMAA penalty added roughly $70 per month above the standard Part B premium. That is $840 per year in extra Medicare costs, for income you no longer have, income that was artificially elevated by the collision of wage income and retirement income in a single transition year. Income Frank could have easily avoided by choosing a different month. The domino hit Medicare 18 months after Frank pushed it sideways. So, the surcharge is based on your income from 2023. But I retired in 2023. That's not my income anymore. Correct. Would you like our mailing address for the payment? If Frank had retired in February instead of December, his transition year income would have landed around $55,000, below the first IRMAA threshold for a single filer, which sits at $106,000 as of recent years. Zero surcharge, not $1 of extra premium. The domino falls straight. The chain lands where it's supposed to. I want to be direct about this, because I think it captures something important about how financial systems actually work. Frank did not make a financial mistake. Frank made a calendar mistake. He retired in December because that is when his career had always been organized. The company milestone was in December. The anniversary was in December. The whole rhythm of 31 working years pointed toward December as a finish line. So that's when he crossed it. And it cost him real money. Not because of markets, not because of mismanagement, because of the month. The first domino doesn't care why you pushed it sideways. It just falls. Now, I told you we'd come back to Frank, and we will, because there is a chapter 2 to his story that changes the ending somewhat. But let's first follow the chain through the third system, because this is where things get genuinely surprising. This is where it gets really interesting. Because Social Security has its own tax logic that operates completely separately from regular income tax logic, and the two systems interact in a way that most people have never had explained to them clearly. Here's how it works. The IRS does not tax your Social Security benefit the same way it taxes wages. It uses something called provisional income. Provisional income is your adjusted gross income plus any tax-exempt interest you earn, plus 50% of your annual Social Security benefit. That formula is the government's way of estimating your total economic picture in a given year. If your provisional income as a single filer is below $25,000, none of your Social Security is taxable. Not a dollar. Between $25,000 and $34,000, up to 50% of your benefit can be taxed. Above $34,000, up to 85% of your benefit is taxable. For married couples filing jointly, those thresholds are $32,000 and $44,000 respectively. Here is a fact that belongs in a museum of fiscal absurdity. These thresholds have not been updated since 1983. That is over 40 years of inflation without a single adjustment. What this means in practice is that more and more retirees are having their Social Security taxed every year. Not because they've gotten wealthier, but because the brackets are standing still while everything else moves. It's a stealth tax increase. Nobody voted for it explicitly. It just compounds quietly. So here's what happens when you retire in December and start Social Security that same year. Your provisional income spikes. $110,000 in wages. Add half your annual Social Security benefit, say $12,000. Provisional income, $122,000. 85% of your Social Security benefit is taxable. Locked in. Every check you receive that year is flowing through the highest taxability tier. Now run February. Wages, $14,000. Half Social Security, $12,000. Provisional income, $26,000. You're barely above the 50% threshold. Nearly half your benefit is tax-free. On a Social Security benefit of $24,000 per year, the difference between 85% taxability and near zero taxability is roughly $17,000 in taxable income. At a 12% marginal rate, that's $2,000 in annual savings every year, for as long as you collect. Over a 20-year retirement, that number reaches $40,000 in taxes that were never actually owed, triggered entirely by the month you stopped going into the office. The first domino hits the Social Security domino. But now you might think, okay, the Social Security math is compelling, but isn't the real money in investment optimization? And yes, that is exactly where this goes next. Here's what nobody is telling you about the Roth conversion window. Most people heading into retirement have the bulk of their savings in tax-deferred accounts, traditional 401ks, traditional IRAs. Every dollar in those accounts has never been taxed. When you withdraw it in retirement, you pay ordinary income tax on the full amount. If you do nothing and let those accounts grow, the IRS eventually forces you to start taking required minimum distributions at age 73. By that point, many people's accounts have grown large enough that the mandatory withdrawals push them into a high tax bracket for the rest of their lives. It's a tax time bomb with a government-mandated fuse. The Roth conversion is how you defuse it on your own terms. You move money from the traditional IRA into a Roth IRA, pay the taxes now at your current rate, and the money grows tax-free permanently. No required minimum distributions, no tax on growth, no tax on withdrawals. The strategy only works well when your marginal rate is low. And the best window for low rates is the gap between when you stop working and when Social Security or RMDs begin pushing your income back up. That window can be 5 to 10 years. It is often the single greatest tax optimization opportunity a person gets in their entire financial life. But if you retire in December, your first retirement year is a high income year. The income stack has already filled the bracket. You cannot do an efficient Roth conversion in year one because you're converting at a high rate, the opposite of the strategy. You've burned your first conversion year before you had any chance to use it. The window opened and you were already standing on the wrong side of the door. If you retire in February, your first retirement year is low income. You've got room in the 12% bracket, potentially a lot of room. You can convert $50,000, maybe $60,000 in that first year, paying 12% on money that would otherwise be forced out at 22 or 24% when required minimum distributions hit. Over 5 years of conversions on a $400,000 IRA, the cumulative tax savings from the bracket difference can approach $50,000 to $75,000. Plus the compounding on permanently tax-free Roth assets across the rest of your life. The window opened because the first domino fell the right way. There's a version of this story that I think about sometimes. Imagine telling someone that the most important tax planning decision of their entire retirement career happened before retirement started, and it was the month they picked to hand in their badge. You spent 30 years choosing funds. You spent a decade worrying about expense ratios. You stress-tested your withdrawal rate, and the variable that either unlocks or closes the biggest tax optimization tool available to you is whether you told HR, April, or November. That is the system. That is genuinely how it works. Now, this is where the story takes a direction I want to be honest about. Because I don't want to oversell the early retirement month argument without acknowledging the real counter-argument. Someone smart is going to say, what about sequence of returns risk? And they're right to ask. Sequence of returns risk is the danger of experiencing bad market performance in the early years of retirement when you are withdrawing money. It's not about average returns. You can average 7% annually over a 30-year retirement and still exhaust your portfolio. If the down years come at the beginning, when you're selling equity to pay bills, rather than in the middle or the end when the portfolio has had time to grow. The order matters. Financial researcher William Bengen, the man who developed the 4% rule back in 1994, showed that retiring into a prolonged bear market can reduce portfolio longevity by 5 to 10 years compared to an identical portfolio entering retirement during a bull market. The math is brutal if you catch the bad years early. Here's how your retirement month connects to this. If you retire in January, you need 12 months of portfolio withdrawals that year. If you retire in June, you need 6 months. If you retire in December, you need maybe 1 or 2 months. Fewer withdrawals in year one means less exposure if markets go sideways. On the surface, this looks like a strong argument for late-year retirement. And you're thinking it, I see it. But here's the reversal. You think the sequence of returns risk is the reason to retire later in the year. Actually, the income stack is a more consistent and more controllable problem for most retirees. The sequence risk is real, but probabilistic. Markets might cooperate, or they might not, and no retirement month changes the odds. The income stack is deterministic. It will happen. The question is only how large you let it get. And the practical solution to sequence risk is not to retire in December. It is to hold 1 to 2 years of living expenses in cash or short-term bonds before you stop working, so you're not selling equity in a down market to cover year 1 expenses. The cash buffer decouples the timing problem. The income stack problem cannot be decoupled. That's the difference between the two risks. Hey, just don't retire during a recession. Oh wow, okay, let me just check the calendar. No recession scheduled. Looks like I'm fine. Let me make this concrete enough to be useful. Picture a man named Michael, 59 years old in 2025. $800,000 in his 401k. A pension that will pay him $36,000 per year. Social Security estimated at $28,000 annually at age 67. He's planning to wait for the higher benefit. His salary for the last several years has been $95,000. He's single. Michael has been planning to retire in September of 2026 because that's when he hits 30 years of service and unlocks his full pension calculation. Smart call on the pension. But September means 8 months of wages, approximately $63,000. Add 10 months of pension income starting in September, $30,000. He pulls $20,000 from the 401k to build a cash buffer. Total taxable income for 2026, roughly $113,000. As a single filer, that crosses the first IRMAA threshold. In 2028, his Medicare premium will include a surcharge. He's also in the 22% bracket through most of his income, which leaves almost no room for a Roth conversion that year without pushing further up the scale. Now move Michael to March. 8 weeks of wages, about $15,000. Pension for 10 months, $30,000. Same $20,000 buffer withdrawal. Total, $65,000. He's firmly in the 12% bracket with meaningful room above him. He can convert $30,000 to $40,000 from his 401k into a Roth IRA while staying under the 22% threshold. His 2028 Medicare premium is assessed against a $65,000 year. Zero IRMAA surcharge. His Social Security provisional income, when he eventually claims at 67, starts in a much cleaner position. Rough lifetime accounting on the difference. $840 per year avoided in IRMAA across multiple years. Approximately $25,000 in Roth conversion tax savings over 5 years of conversions. Reduced Social Security taxability, saving roughly $2,000 per year for 20 years. Total, somewhere between $50,000 and $60,000 in avoidable costs from moving a retirement date by 6 months on a calendar that already existed. The first domino. Back to Frank. When he got that IRMAA surcharge notice in 2025, his first assumption was that the damage was permanent. The income was already on the 2023 return. Nothing could change that. And in terms of the return itself, he was right. But his new advisor told him something he hadn't heard before. There is a formal appeals process for IRMAA called a life-changing event appeal. If you've experienced a significant qualifying life change, and retirement is explicitly on the list, you can petition Medicare to use your more recent year's income instead of the 2-year-old figure. Frank filed the appeal using a form called SSA 44. He documented his retirement. Medicare reviewed it and agreed. The surcharge was removed. He got the money back. He was relieved. And then he was irritated again because the process took months and required documentation and follow-up and 2 phone calls to Social Security that he did not enjoy. The form exists. Most people don't know about it. Some people pay IRMAA surcharges for years without ever learning they can contest them. If you're already in this situation, the SSA 44 is worth your afternoon. But the cleaner version of Frank's story is the one that never happened, where he looked at a calendar in late 2022 and moved his retirement date to February. No stack, no domino, no appeal, no phone calls. Now the pension rule. I promised you this near the beginning, and I want to deliver it properly, because this is the one that consistently surprises people the most, and it is the most actionable thing I'm going to say in this entire video. Many defined benefit pension plans, The kind that pay you a fixed monthly amount for the rest of your life. Calculate your benefit based on years of service. A common formula looks something like this: 1% per year of service, multiplied by your final average salary, equals your annual benefit. Straightforward enough. Here's what's not in any benefit summary you've ever received in an email. A surprising number of pension plans credit you with a full year of service, even if you work only one day into the new calendar year or plan year. It varies by employer. Some plans use a calendar year, some use a fiscal year. Some use something called an anniversary year tied to your hire date. But the implication for plans that use a calendar or fiscal year structure is that working one day into January can permanently add a full year of service to your pension calculation. For a pension using the 1% formula on a $90,000 final average salary, one additional year of service credit adds $900 per year to your benefit for the rest of your life. Over a 25-year retirement, that's $22,500 in additional income from what amounts to a single day of work. Nobody advertises this. It is not in a poster in the break room. It is in the summary plan description, which is the document most employees receive once, store in a folder, and never read again. The cost of not reading that document, for some people, is a permanent reduction in monthly income for the next quarter century. That is what an unread PDF costs. Read it. Let me close the loop on everything I've laid out, because I want to give you something you can actually use before you click away. 3 things. Specific ones, not consult a financial advisor. You already know that. First, model your transition year income before you pick a retirement date. Take your expected wages through your intended retirement month. Add every income source that starts in that same calendar year. Pension, Social Security if you're taking it immediately. Add any planned 401k withdrawals and see where your taxable income lands. Then look at the tax bracket thresholds for 2026, which for single filers have the 12 to 22% line at approximately $47,000, and for married filers at roughly $94,000. If moving your retirement date 2 or 3 months earlier keeps you in the lower bracket for a significant portion of your income, that difference has a real dollar value. This calculation takes an hour. Do it before you do anything else. Second, project your IRMAA exposure. Whatever your total taxable income is in the year you retire, that is the number Medicare will use to assess your Part B premium 2 years later. For 2026 retirements, Medicare will look at that income in 2028. The first IRMAA threshold for single filers is currently around $106,000. If your transition year income is close to or above that line, and you can reduce it by retiring earlier in the year, the annual premium savings justify the planning effort many times over. If the damage is already done from a prior year, look up SSA 44 and understand the life-changing event appeal process before you assume you're stuck. Third, read the summary plan description for your pension before you finalize any date. Find the section on years of service accrual. Look for language about plan year, calendar year, or anniversary year. Whether working into January gives you an additional year of service credit. For some people, this information is worth working an extra few days. For others, the plan structure makes it irrelevant. You cannot know which situation you're in until you read the document. 25 years of higher monthly income is a reasonable reward for reading 40 pages. Here's what connects everything. People spend decades optimizing the accumulation side of retirement, saving rates, asset allocation, expense ratios. They argue online about whether one fund has a 0.05% advantage over another fund. Then they pick their retirement month because the office holiday party is in December, and it feels like a natural ending. The optimization breaks down at the exact moment it matters most. This is not a failure of intelligence, it is a failure of framing. The decisions that feel like logistics, the month, the specific date, the paperwork sequence, those are the decisions the brain deprioritizes because they don't look like financial choices, they look like scheduling. But the first domino is always the one that doesn't look like a domino. The good news is that this problem is uniquely solvable. You're not dealing with market timing. You're not dealing with interest rate forecasts or geopolitical tail risk. You're dealing with a calendar. The calendar is in front of you. You have complete control over which box you circle. Lazy investing built more fortune than crypto memes. And lazy calendar management has quietly destroyed more retirement plans than any bear market on record. The month you retire is a lever. Pull it on purpose.